Have you ever looked at the financial markets and felt like there were these, I don't know, incredibly powerful tools operating just beyond your grasp, almost like a secret language?
Oh, absolutely.
How do you really get an edge, manage significant risk, or even place those big bets on market moves without getting completely lost in all the financial jargon?
It really can feel like navigating a maze sometimes.
Yeah, it often is complex, let's be honest.
Mhm.
But today, we're going to try and cut through some of that complexity. We're taking a deep dive into the fascinating and, yeah, sometimes intimidating world of derivatives.
Right.
We've pulled together a stack of insights, articles, research, our own notes to really demystify them. Our mission for you, the listener, is to walk away not just knowing what derivatives are.
But why they matter.
Exactly.
Yeah.
How they fundamentally work and what their, pervasive role in global finance truly means.
And you've hit on something crucial there. Derivatives do carry this initial perception of being incredibly complex, almost like they're only for the big institutional players. But at their core, they're financial contracts.
Right.
And their value, well, it's derived from something else. That could be an underlying asset, like a stock or maybe a benchmark.
Derived. Okay.
And what's truly powerful and sometimes, frankly, perilous about them is this dual nature. They can be incredibly effective tools for hedging, essentially reducing financial risk.
Like insurance.
Sort of, yeah. And also for speculation taking on risk deliberately for the potential of a significant reward.
Okay.
Now, because of that power, and this is really vital, we have to state up front, derivatives are inherently speculative. By their very nature, they are risky.
Right.
So for any specific financial advice, you should always consult a licensed professional. That's just crucial.
Absolutely. That's a critical point to remember as we unpack this.
Right.
So, okay, if their value is purely derived, what does that actually mean for these contracts themselves? Where do we even begin to get our heads around these things?
Well, let's start with the basics.
At its essence, a derivative is.
Yeah.
It's a financial contract, agreed upon between two or more parties.
Mm.
Its value comes not from the contract itself, but is literally derived from an underlying asset.
Mm-hmm.
That could be anything, right? Like a stock, a bond, maybe a barrel of oil.
Currencies, interest rates, market indexes.
Plus even a whole group of assets. So it's like a contract about an asset rather than owning the asset directly.
Exactly. And the real insight here isn't just what they are, but how they trade. That changes everything.
How so?
Well, you'll find some trading on regulated exchanges. Think of the Chicago Mercantile Exchange, the CME, one of the world's largest, very structured.
Okay, regulated.
But a massive portion, and this is key, trades over the counter. Over the counter, meaning?
Meaning they're negotiated directly, privately, between two parties, no central exchange.
Yeah.
And the crucial distinction there is that OTC derivatives typically carry a much greater counterparty risk.
Counterparty risk, the risk the other side won't pay up. Precisely. The danger one party might not fulfill its obligations. This lack of transparency and regulation in OTC deals, well, it really shows the sheer human need for these bespoke, tailored financial solutions, even if it means taking on more, let's say, hidden risk.
So OTC derivatives often come with this less visible but significant counterparty risk.
Okay. And speaking of significant, another key characteristic. You mentioned leverage earlier.
Yes, that's absolutely fundamental.
Derivatives are almost always leveraged instruments. This means you can control a much larger position in that underlying asset with a relatively small amount of capital upfront.
That's right.
So leverage isn't just a multiplier for potential returns. It's what makes derivatives incredibly capital efficient for both hedging and speculation. It allows for big plays with relatively small initial commitments.
That's a brilliant way to put it. That capital efficiency is precisely why they're so widely used. They essentially serve as a mechanism for risk transfer.
Risk transfer. Yeah, moving risk levels from those who want to avoid it, maybe like a company hedging, to those who are willing to take it on, often for that potential upside, like a speculator.
So it's about efficiently allocating who holds which risk in the market.
Exactly. It's a core function.
It sounds like quite an ingenious system, really, for managing risk and for speculation. But if they're so complex and often so risky, why did these instruments even come into being in the first place? Their origins tell a bit of a story, don't they?
They do, actually. It's quite interesting.
It turns out derivatives have this fascinating historical context. They were originally developed for international traders, way back when, mainly to manage constantly changing currency values.
Right. Think about it.
Imagine trying to trade goods across borders when the value of money is constantly fluctuating. It's chaotic.
Yeah.
These contracts helped ensure balanced exchange rates, providing a crucial element of stability.
Let me give you a concrete example. Let's picture a European investor. Their accounts are all in euros. They decide to buy shares of a U.S. company, paying in U.S. dollars. Suddenly, they're exposed to exchange rate risk, right?
Because the euro-dollar rate could change.
Exactly. If the euro strengthens against the dollar before they sell that stock, any profits they make on the shares will convert back into fewer euros. Their actual return shrinks.
Okay, I see the problem.
So this is where a derivative could step in. That investor could buy a currency derivative to lock in a specific exchange rate. They're hedging that risk.
Protecting themselves.
Or, on the flip side, a speculator who expects the euro to appreciate against the dollar could profit from a derivative that rises with the euro, crucially, without needing to own the actual U.S. stock at all.
So they're just betting on the currency move itself.
Precisely. And what's truly insightful about their origin in currency management is how it reveals derivatives fundamentally grew out of a need for stability in an unstable world. It wasn't just pure profit-seeking initially.
That's a crucial distinction, isn't it? The difference between using them to mitigate an existing risk versus using them to create a new speculative risk.
Absolutely fundamental.
Like take an airline, for example. When they buy fuel futures,
Classic example.
they're not really speculating on the price of oil,
Hmm.
hoping it skyrockets so they make a killing.
No, not at all.
Instead, they're making a strategic decision to limit an existing business risk, the risk that rising oil prices will just eat into their profit margins. They want predictable costs.
They're trying to protect their bottom line, secure their costs, not make a speculative gain on the commodity itself. It's insurance for their operations.
Right. It's risk management.
Precisely. And when we talk about the main types of players, or rather products in this market, we can broadly introduce two classes: lock products and option products.
Lock and option. Got it.
Lock products think futures, forwards, swaps. They legally bind the parties to agreed terms for the entire life of the contract. It's a commitment.
Locked in.
Locked in. Option products, however, they give the holder the right, but crucially not the obligation, to buy or sell the underlying asset. It's a choice. You pay for that choice.
That distinction between obligation and right sounds huge. Let's dive into the most common types then. Maybe starting with futures contracts.
Good place to start. Very common.
Okay, so a futures contract is...
Yeah.
It's essentially a standardized agreement. Two parties agree to buy or sell an asset at a predetermined price on a specific future date.
Standardized is the key word there.
And these trade on regulated exchanges, and crucially, both parties are legally obligated to fulfill their side of the deal. So why does that standardization matter so much?
Well, standardization on an exchange is everything for liquidity and transparency. It means the contracts are interchangeable.
Easier to trade.
Much easier to trade, yeah. And it helps with price discovery. Everyone sees the same prices. Our sources give a great oil futures example.
Okay.
Imagine Company A buys an oil futures contract for, say, $62.22 per barrel, expiring on December 19th. They do this because they need oil in December and they're worried prices will go up. They're hedging.
Makes sense.
The seller is then obligated to deliver at that $62.22 price. Now, if oil jumps to $80 a barrel by December,
Company A is happy.
Company A is protected. They either take delivery at the lower price or, more likely, they can sell their profitable contract before expiration.
Right. They cash in the difference.
Exactly. Now, look at the speculative side. A WTI oil contract that's West Texas Intermediate, a key benchmark representing 1,000 barrels, rises from $62.22 to $80.
Okay.
A buyer who took a long position, basically betting the price will rise, would profit. Let's see, $17,780, a significant amount.
Wow.
Conversely, the seller, who took a short position, betting the price would fall, would lose that exact same amount.
A zero-sum game.
It's a zero-sum game between those two parties, yes.
That's a powerful amplification of market movement. And here's where it gets really interesting, right? Not all futures involve actually delivering the physical stuff.
That's a very important point. Many are cash settled.
Cash settled. So no oil tankers showing up.
Ha! Unlikely. Unless you specifically arranged for physical delivery, which is less common for financial players. Usually, the gain or loss is simply an accounting entry, a cash flow to the trader's brokerage account.
Okay.
You see this with lots of futures. Interest rate futures, stock index futures, even things like volatility futures, or, believe it or not, weather futures.
Weather futures.
Seriously.
Oh, yes. Hedging against, say, a drought or a colder winter, it's all cash settled based on measured outcomes.
Fascinating. Okay, so futures offer standardization, liquidity, exchange trading. But what if you need something more tailored, something specific for a unique situation?
Well, that's where we move into the world of forward contracts.
Okay.
They are similar to futures in their core agreement, buy or sell at a future date and price.
Yeah.
But there's a crucial difference. They don't trade on an exchange.
Only OTC.
Only over the counter, yes. Which means forward contracts are highly customizable.
You can tweak the terms. Exactly. The terms, the size of the contract, the settlement details, it can all be tailored. This bespoke nature is their primary appeal. Parties can create precisely the contract they need for a specific risk.
There's always a but.
There's always a but. This customization also means they carry a greater counterparty risk compared to exchange-traded futures.
Because they're unregulated.
Unregulated, privately negotiated. The danger that the other party might not deliver on its obligations is significantly higher. It's the trade-off you make for that flexibility.
That increased counterparty risk is a big deal. And our sources mentioned it can actually get even more complicated, right? Parties offsetting positions with other counterparties?
Yes, that happens. You can end up with these complex webs or chains of obligations. If one link in that chain breaks, if one party defaults, it can cascade and amplify those counterparty risks significantly.
Sounds potentially messy.
It can be, yeah. Lack of transparency is a real issue there.
Okay, let's pivot then. Let's talk about swaps. Another common and sometimes, let's say, infamous type of derivative.
Often used, and yes, sometimes linked to financial stress. Swaps are essentially agreements to exchange one kind of cash flow for another.
Exchange cash flows. Like how?
A classic example is an interest rate swap. Imagine company XYZ has a $1 million loan with a variable interest rate, currently 6%.
Okay.
They're worried rates might rise, increasing their borrowing costs. They want certainty. So they create a swap agreement with, say, company QRS.
Another company.
Right. Company QRS agrees to pay XYZ the amount based on that variable 6% rate. In return, XYZ agrees to pay company QRS a fixed rate, let's say 7%.
So XYZ pays fixed, QRS pays variable.
Exactly. The brilliant part for company XYZ is they no longer really care what the variable rate does day to day. Their net interest payment is now effectively fixed at 7%, regardless of market fluctuations. Company QRS is essentially taken on that interest rate risk in exchange for receiving the fixed payment.
How does the actual payment work?
Usually they just exchange the difference. So initially XYZ pays QRS the 1 percentage point difference between 7% fixed and 6% variable. If rates then fall to 5%, XYZ would pay QRS the bigger 2-point difference. But if rates rise to 8%, then QRS would actually have to pay XYZ the 1-point difference.
So the swap achieves XYZ's goal.
Yeah.
Predictable interest payments.
Exactly. It offers them vital predictability for planning and budgeting.
And swaps aren't just for interest rates, right?
Not at all. They can be structured to manage currency risk or default risk. That's what credit default swaps, CDS, are famous or infamous for.
Right, the 2008 crisis connection.
Precisely. CDS played a huge role there, often tied to mortgage bonds. They can also be used for cash flows from other business activities. But yeah, their role in 2008 highlighted how these complex webs of swap obligations, especially CDS, could contribute to systemic risk.
Okay, complex and powerful. Finally, let's get back to options contracts. We touched on this, but that core difference from futures seems really important.
It's fundamental.
The buyer of an option has the right, but crucially not the obligation, to buy or sell the underlying asset.
Correct. It's an opportunity, not a firm commitment like a future. And that flexibility, that choice, comes at a cost.
The premium.
The premium, exactly. That's the price you pay for the option itself. And that flexibility is precisely why they're so appealing for very targeted risk management or for speculation. You know, while options come in different styles, American, European, which affects when you can exercise them.
American anytime, European only at expiration.
Broadly, yes. American style, common for stocks, lets you exercise any time before or on expiration. European style, often for indexes, is only exercisable on the expiration date. But honestly, for most investors, the core takeaway is that right, not obligation aspect. The strategic choice of using an option is often far more critical than these timing details.
Makes sense. Can you give us an example of hedging with options, that protective put idea?
Sure. Let's say you, an investor, own 100 shares of a stock currently trading at $50 per share. You think it might go up, but you're worried about a potential drop.
Downside protection.
Exactly. You could buy a put option. This gives you the right to sell your shares at a specific price called the strike price. Let's say you buy a put with a $50 strike price. Maybe it costs $2 per share for this option, so $200 total for 100 shares. That's your premium, your insurance cost.
Okay, $200 for the right to sell at $50.
Right. Now, if the stock unfortunately falls to, say, $40 per share by the time the option expires.
Normally a $1,000 loss on the shares.
Correct. But because you own the put option, you can exercise your right to sell those shares at the $50 strike price. So your maximum loss on the shares is capped. You still lose the $200 you paid for the option premium.
But that's much better than losing $1,000.
Absolutely. It's a powerful way to define and limit your downside risk. You know exactly what your worst case loss is.
Okay, that's hedging. What about speculation using options, the call option?
Right. So a call option gives the buyer the right to buy an asset at a specific price. Let's say an investor doesn't own a stock currently at $50, but they strongly believe it's going to rise significantly.
They're bullish.
Very bullish. Instead of buying 100 shares for $5,000, they could buy a call option. Maybe a call option with a $50 strike price costs $2 per share premium. So $200 total again.
Okay, $200 for the right to buy at $50.
Exactly. Now, if the stock does rise, say, to $60 before the option expires.
You can exercise the option.
Right. They exercise their right to buy the 100 shares at the $50 strike price. They could then immediately sell those shares in the market at the current $60 price.
Making $10 per share profit.
$10 per share profit, yes. Now, you have to subtract the $2 per share premium they paid.
So $8 profit per share, $800 total.
Around $800 net profit, yeah. All achieved with just a $200 upfront investment, rather than needing the full $5,000 to buy the shares outright. That's the leverage effect in options.
That leverage really cuts both ways, though. If the stock didn't go up,
If the stock stayed below $50 or didn't rise enough to cover the $2 premium, the call option would expire worthless. The speculator loses their $200 premium. That's their maximum loss on the option trade itself.
so in both the put and call examples, the seller of the option, they're the ones obligated if the buyer exercises.
Correct. The seller, or the option writer, takes on the obligation. Their potential profit is limited to the premium they received up front.
And if the option expires worthless,
The seller just keeps that premium. Free money. Well, not exactly free. They took on the risk, the obligation, for that period. It's a calculated trade-off of risk and reward for both the buyer and the seller. The premium is the payment for that flexibility or that obligation.
okay, we've covered the core concepts, the main types, futures, forwards, swaps, options. It's clear they are incredibly versatile, incredibly powerful. But we've also definitely hinted at their downsides. It feels like they function as this kind of high-powered amplifier in finance, doesn't it? For good and bad?
Absolutely. That's a great way to put it. On the plus side, derivatives offer incredible ways to lock in prices, hedge against unfavorable market movements, genuinely mitigate risks.
Like our airline example.
Exactly. They can even help with portfolio diversification, sometimes with relatively limited initial capital because of that leverage. They are truly vital tools for a functioning global economy, allowing businesses to plan and manage costs effectively.
The other cons.
But the cons are significant. That derived value makes them inherently difficult to price accurately. Their value is super sensitive to external factors, time decay, volatility, interest rates, holding costs.
Lots of moving parts.
Lots of moving parts. Then there's that pervasive counterparty risk we talked about, especially for those complex, opaque OTC derivatives.
Right.
Their inherent complexity also makes them really challenging for many people, even professionals sometimes, to fully understand. You can end up with unforeseen exposure
It's outrage.
and leverage, the amplifier. While it boosts potential returns, it equally and often much more quickly accelerates potential losses, sometimes devastatingly fast.
And we have seen how these tangled webs of derivative contracts can lead to broader systemic risks, threatening the stability of the whole financial system.
We certainly have. It truly is a force that cuts both ways. A double-edged sword.
So, okay, let's try and bring it all together.
Yeah.
Derivatives. They are financial securities. Their value comes from an underlying asset.
Yeah.
Fundamentally, they are tools used for hedging existing risks or for speculating on future market movements.
That's the core of it. And what's truly mind-boggling, I think, is just their sheer scale and customization. While we've discussed the main types, futures, options, swaps, their flexibility allows for almost infinite customization, especially in that huge OTC market.
Tailor-made contracts.
Tailor-made, exactly. They are absolutely ubiquitous in modern finance. Our sources estimate something like $715 trillion outstanding globally as of mid-2023.
715.
Trillion.
Trillion, yeah.
Yeah.
It's a staggering number. It just
Yes.
underscores their massive importance and, frankly, their potential impact, positive and negative, on the entire financial world.
Wow. Well, hopefully you, our listener, now have a far clearer understanding of these powerful, ubiquitous, and yes, sometimes controversial financial instruments.
From their relatively simple origins, managing currency risk for international trade, all the way to their current incredibly complex forms, derivatives are undeniably shaping our economic landscape in a really profound way.
They really are. And if we try to connect this to the bigger picture, you know, derivatives offer this incredible flexibility and efficiency in managing risk and allocating capital, yet that very complexity and interconnectedness also present these profound risks to the global financial system.
This systemic risk question again.
Exactly. And it raises, I think, a really important question for all of us to think about. How do you think we truly balance the innovation and the clear utility of these instruments against the potential for systemic instability that they also represent?
That's a heavy one. Definitely something to chew on, wouldn't you say?
For sure.
We really encourage you to keep exploring, keep questioning, and keep diving deep into the world around you.